we're taking a little bit more of a cautious approach. So we've seen an overabundance of corporate caution here. Despite the fact that we do know that the Fed is likely going to move potentially in July, we still think that we need to see some de-escalation in the trade rhetoric and some good old-fashioned earnings growth to actually be able to sustain a rally above 3,000. So we're feeling a little bit cautious here, moving more towards the credit complex than we are in equities.
Kristen, did the Fed change anything for you?
No. So at this point in time, we're actually the same as Maddi mentioned. We're a little bit more cautious, looking at U.S. equities hitting all-time highs. We want to go into next week with the G20 summit being a little bit more cautious simply because there's still no resolution on trade. And so the market is behaving as though the Fed is going to be the savior here. But until we get more information about trade and the outcome on trade, that does have the impact to affect corporate earnings and to potentially see a pullback. So we're sitting tight until next week.
There are some option strategies that you think are good ways to sort of protect your portfolios at the moment. Talk us through some of those.
Absolutely. So one of the things, instead of simply like adding to your portfolio or making these tough decisions between staying invested or going into cash, we love option strategies in this market. So one interesting thing that's happened is that we've seen this rally in the S&P 500. We've seen the collapse of volatility. If you are someone who believes that we're going to see a rally in U.S. equities on the back of good news next week, you can buy very cheap upside to participate over the next 2 months. So don't go long, actually go long via options. And then on the flip side, if you're someone who's fully invested, you can also take advantage of that low volatility to buy protection over the next couple of months and really kind of ensure your portfolio such that you're immune regardless of the outcome.
And you said you like some opportunities right now in credit, Maddi?
Yeah, so we're feeling much more constructive in the credit complex versus equities. We want to go for a lower beta approach. We do believe in the upside potentially of equities at this point, but it's somewhat capped given the escalation in trade. So in credit, we prefer more of the high quality approaches, some of the securitized credit market that leverages the burgeoning and really resilient U.S. consumer.
Stephanie, we talk a lot about the way bonds have moved since the last S&P 500 record closing high on April 30th. The yield on the 10 years has gone from 2.5 down to 2%, 21% fall in the yield, and people saying that that's a relatively bearish move alongside equities hitting a high. When you factor in that gold's up nearly 10% over that period of time and oil is down 10%, even after today's move, does that not worry you?
Oh, a lot worries me because there's so much uncertainty, right? But I think that we have to just get through next week. One way or the other, we will have more certainty, right? And we will know which sectors and which stocks to own within the equity complex. Right now, as you guys know, I've been doing more of a barbell, right? I own a lot of defensives, but I also own a lot of cyclicals because I just don't know at this point. And you can't be too extended on sectors and being overweight on sectors because you just don't know and you don't want to get hit so hard that you can't make a comeback when we do get that certainty. But I will guarantee you when we get the certainty one way or the other, I think the multiple actually can expand because that's what we've seen all year long. As we kind of chip away at some of these uncertainties, we've gone from 13.9 times forward estimates on the S&P 500 to as high as 17.3 times. We've pulled back to 16 times. We'll see where we go.